Everyone is watching the interest rates. But you know what? They're looking at the wrong cliff. The real crash isn't coming from the bank, it's coming from across the border.
Okay, let's dive right in. We're going to break down three massive forces that are all set to collide with the Canadian economy in 2026. We'll start with the one that's brewing closest to home, this huge, almost invisible tsunami of household debt.
So where does this story even begin? Well, it starts with a number that's so big it's kind of hard to wrap your head around. $2.3 trillion. That is the total weight of mortgage debt that Canadian families are carrying as we head into this really critical period.
But here's the thing, it's not just the size of that number that's dangerous, it's the timing. By the end of 2026, a whopping 60% of all mortgages in Canada are coming up for renewal. And they're going to be renewing at much, much higher rates. We're not talking about a gentle slope here. This is a straight-up financial cliff.
Now, this shock isn't going to hit everyone the same way. Not even close. It's actually creating what you could call two completely different Canadas. On one side, you have the gifted. These are people getting, on average, over $100,000 from family to help pay down their mortgage. But on the other side, you've got the unbuffered. About 1 in 10 households with less than a month of savings, totally exposed to payment hikes that could be 15, even 20% higher.
You know, this deep divide between those who have a family safety net and those who are facing this thing alone, it's not just some abstract idea. It has a real geography. You can actually see it on a map. So for Act 2, we're going to zoom in on Ground Zero, the Windsor-Toronto axis.
See, if you only look at the national data, you miss the real story. The pressure is building up in very specific places and very specific industries. For example, public health, it's pretty much shielded. But look at steel and auto. They're facing critical risk from tariffs. And this isn't just about trade policy. It's about jobs, and by extension, mortgages, right in Canada's industrial heartland.
And believe me, this link is not just theoretical. When those trade-sensitive sectors get hurt, the pain shows up directly in mortgage stress, and we have the proof right here. While the national average for people falling behind on their mortgage is still pretty low, the Greater Toronto Area has seen a shocking 60% jump year over year. That's a huge leading indicator.
And if you think that's bad, just take a drive down the highway from Toronto. The situation gets even worse. An unemployment rate of over 11% in Windsor, a city that was literally built on manufacturing and trade. That is a massive, massive red flag. This Windsor-Toronto axis is where all that abstract risk becomes real-world job losses, and that creates the perfect storm for forced home sales. So how are people defending themselves? Well, that brings us to Act 3. With all this pressure building, people are getting smart. They're getting strategic. They're using some pretty powerful legal tools that are basically financial survival kits. But, and this is a big but, all of this is happening in the shadow of something much, much bigger.
Okay, let's pause for a second because we need to talk about the main defense people are using. It's called a consumer proposal. Now, it is so important to understand this is not bankruptcy. Think of it more like an insolvency shield. It's a legal move that lets you settle your other debts, like credit cards, so you can protect your most important asset, which for most people is their home.
So how does this actually work? Well, it's basically a 4-step survival plan. First, you file the proposal. That immediately triggers something called a stay of proceedings, which freezes your payments on debts like credit cards and lines of credit. Right away, your monthly cash flow is freed up, and you can redirect that money to cover your now higher mortgage payment. It's a clever move. People are essentially sacrificing their credit scores to save their homes.
It's a really powerful defense, right? But here's the question we have to ask. What happens if the very economic foundation that these strategies are built on just cracks? What if the whole game changes, literally, on a single day? Because all of this financial maneuvering at the household level, it's all happening while this giant external threat is looming. And this one has a hard, non-negotiable deadline. We're talking about the USMCA, the big trade deal. On July 1st, 2026, it faces a mandatory sunset review. On that one day, all 3 countries have to agree to extend the deal. If they don't, it's over.
And that is why July 1st, 2026 is the main event. It's a binary choice, yes or no. It's the black swan that's been hiding in plain sight this whole time. Because if that trade deal falters, the shockwave it would send through manufacturing, through the auto sector, right through the heart of that Windsor-Toronto axis, well, it would make all those clever household defense strategies completely irrelevant. The data really couldn't be clearer. The final cliff we need to worry about isn't the bank, it's the border.